how does retail finance work, and what are the key requirements for customers and dealers?
Little tiny bit of a history lesson. This has been going on now since pretty much post World War II in terms of the way financing has happened for dealerships, and especially as dealerships have got bigger and bigger, and the amount of capital required to run a dealership has become large enough that you need external funding sources. So a financier is able to provide the floor plan finance. That is usually on a floating basis. So that will fluctuate with whatever the rule of thumb or the reference rate that is either done as, it could be on the 90-day bank bill rate, whatever. And that rate is tend to be held for 30 days only and reviewed every 30 days with the dealer. And the reason that's done, and often, as I said, financiers will provide that funding at almost no profit. And there have been instances where it's done at a loss. But it's done because the retail finance part of the quid pro quo, if you like, is the dealers assist customers with finance in order to sell their cars. So this goes back to General Electric and Westinghouse, and that's how they used to sell fridges and ovens and washing machines in the early 50s after World War II. No one had the money to pay for it cash, so they funded those people to buy their own. It was vendor finance. And so the dealership model quickly adapted that. What that means is, if I'm a dealer, I've done a deal with a financier, and let's say I've got 10 or 15 or 20 or $100 million worth of floor plan finance, the financier will say to the dealer, there's that money at a very, very low rate. We're not making much on it. We possibly aren't making anything after costs. But in return, we require you to give us a retail support ratio or an RSR. And invariably, that number tends to be around 10 or 15% per month. What that means is, if, let's say I've got $10 million in floor plan, fully drawn, so I've got $10 million worth of stock that I've then given to the financier, and I basically borrowed that stock back off the financier so I can sell those cars. Each month, that financier would expect me to introduce buyers of cars who need finance. And we have to remember, about 90% of people who buy cars still in this country and around the world, about 90% of them require other people's money. They don't have the cash, so they use somebody else's money. That could be a credit card, it could be a mortgage redraw. In a lot of cases, it's or a personal loan, or it's an asset-backed financial arrangement with a financier. So the dealer actually introduces those customers, and the dealer does that for two very, very good reasons. Firstly, if the customer gets money to buy the car, the customer buys the car, the dealer makes a profit, hopefully, on the sale, and that's good business. Secondly, the financier is expecting a better rate on that retail finance because retail customers just pay a higher interest rate than corporates in any case, and that's supply and demand. But the big difference is there, the dealership introduces those customers who get a fixed rate loan for between 12 or 84 months, 1 to 7 years. Now, there are slight differences in terms of the costs on those retails, but the financier, because the customer is locked in for a longer time, the longer the period, the more interest is paid. That's just the way it works. That's the mathematical calculation. And so the financier is happy to take that higher grossing retail, we call it retail paper in the trade, or retail loans. And for that, everybody makes an earn. Now, to incent the dealer to do that, the dealer has probably got some kind of incentive program in line with their wholesale financier, whether it be a commission on the successful introduction of finance contracts, or it might be an offset that lowers the cost of floor plan even further. And they're the two main ways the financier incents the dealer to make sure that they introduce all those bits and pieces.